Porsche just told the world it's stepping back from electric cars, and in the very same breath confirmed that two brand new electric sports cars are still on the way. That's not a contradiction. That's not a company that's lost the plot. It might actually be the most important thing any automaker has said all year, and almost nobody covering it caught what was really going on. Here's the part that should make you pause. The numbers Porsche released right after that announcement prove this wasn't a bluff, and it wasn't panic either. Stick around, because this one move could reshape how every car maker on the planet thinks about the road ahead, whether they realize it yet or not. Let's start with what actually happened, because the drama isn't really the point here. The meaning behind it is, through the first half of 2026, Porsche's new CEO, Michael Leiters, has been publicly walking the company back from its all-electric ambitions, one announcement at a time. He's ruled out an all-electric 911 for good. He's confirmed combustion engines will stay in the lineup well into the 2030s. And around the same time, German reporting suggests he's pushed the fully electric Panamera further down the road and started putting distance between Porsche and the software partnership Volkswagen built with the American EV maker Rivian. One more sign of Porsche loosening its grip on the electric-first vision it once championed louder than anyone. To understand why this matters, you have to look at the mess leaders actually walked into. Because it's brutal. This is a brand that once promised 80% of its sales would be electric by 2030 and poured billions of euros into making that happen. In 2025, that bet blew up. Full-year operating profit collapsed 92.7%, dropping from 5.64 billion euros to just 413 million. Look at the automotive division alone, and it's even uglier. Operating profit there fell 98.3% from 5.3 billion euros down to a mere 90 million, practically nothing against more than 32 billion euros in car sales. The company booked around 3.9 billion euros in one-time charges to make the pivot official, with over 2 billion of that going just to unwind the electric strategy itself. Plus hundreds of millions more tied to battery investments and new U.S. tariffs. China, once Porsche's growth engine, kept slipping. The stock dropped more than 30% for the year, and Porsche got booted from Germany's blue-chip DAX index. 4 separate profit warnings landed before the year was even done. That's the fire leaders inherited on January 1, 2026, taking over from Oliver Blume, who's staying on as CEO of parent company Volkswagen Group. This pullback is Leiters' way of putting that fire out. On the surface, his approach looks like one thing: total surrender to the gas engine. The evidence stacked against electric is hard to miss. The upcoming flagship SUV, codenamed K1, was originally meant to be Porsche's boldest electric statement. A massive 3-row EV built to go head-to-head with the electric Range Rover. It's now been rebuilt entirely on Volkswagen Group's combustion platform, sharing its bones with the upcoming Audi Q9, arriving around 2028 with V6 and V8 engines plus plug-in hybrid options. No electric-only version in sight, at least for now. Combustion power is confirmed to stay in the Cayenne and Panamera lineups well into the next decade, including brand-new gas-powered generations of both. And Porsche is quietly unwinding parts of the Rivian software partnership that was supposed to be its bridge to a Tesla-level digital experience. Every outlet covering this ran some version of the same headline: Porsche gives up on electric. Porsche admits the EV dream is dead. Nearly all of them missed the one detail that undercuts that entire story. Buried in that same string of announcements is a line that makes the surrender narrative fall apart. Leiters confirmed in an interview just last week that the fully electric 718 Boxster and Cayman are still happening, not shelved, not quietly killed off the way many industry insiders expected. He reportedly called it a fantastic car and said the company is moving forward with it. Full stop. 2 brand new electric sports cars, pushing ahead right in the middle of what every headline called a retreat from electric. Sit with that for a second, because it just doesn't fit the surrender story. If Porsche were truly abandoning electric cars altogether, the 718 twins would be the first casualties. They are low volume, expensive to engineer, and aimed at a buyer who, by Porsche's own admission, hasn't shown much enthusiasm for an electric Boxster or Cayman so far. Killing them would have been the easy, obvious call. Instead, Porsche protected them, which tells you this was never really a surrender in the first place. It's a hedge, and that one word is really the whole story. Porsche isn't walking away from electric cars, it's walking away from the idea that it has to bet the entire company on electric alone, arriving on one fixed timeline, whether the world is actually ready or not. That's a completely different move, and honestly a far more radical one than a simple retreat. For roughly a decade, the car industry has operated under one unspoken rule: pick a future. Commit everything to it, and move first, because the companies that hesitate get left behind. Every executive believed it. Every investor demanded proof of it. Tesla built its entire trillion-dollar case around it. And Porsche believed it harder than almost anyone else in the luxury space, which is exactly why the bet nearly broke the company. Now Porsche has done something nobody else in the industry has had the nerve to say out loud, that all in rule might just be wrong. Build gas, hybrid, and electric side by side on purpose and let customers decide which future actually shows up instead of a strategy team betting the whole balance sheet on a guess. If that sounds like a soft, indecisive non-answer dressed up as strategy, hang on. Because the numbers Porsche released days later make it look like one of the smartest calls in the industry right now. In late July, Porsche reported its first half 2026 results, and the proof is right there in the delivery numbers. Look at what people are actually buying. Group-wide deliveries fell 16.5% to 122,306 vehicles, the weakest first half in 6 years. That sounds bad until you break it down model by model. The 9111, the oldest, most stubbornly analog gasoline car in the whole lineup, grew 19 to 30,534 units, outselling the electric Taycan by roughly 5 to 1. In the U.S. specifically, 911 deliveries didn't just grow, they surged, up 56.3% year-over-year to 8,478 units. Meanwhile, the fully electric Taycan fell another 25%, down to just 219 deliveries worldwide. Read that back slowly, because it captures the whole argument in one sentence. At the same company, in the same 6 months, the gas car is booming while the electric flagship is fading. That's about as clear a piece of evidence as you'll find that nobody, including Porsche itself, actually knows which direction this market is heading. And that uncertainty is exactly why Porsche stopped pretending it had the answer and started quietly building for both outcomes at once. Here's the number that turns this from a headline into a real strategy. Even with total deliveries down double digits and China still bleeding, group operating profit jumped 34% to 1.35 billion euros. The automotive division's operating margin climbed from 5.2% to 8%, and the group's overall return on sales rose from 5.5% to 7.8%. Sit with that for a second. The company sold noticeably fewer cars and made significantly more money doing it. The approach every headline mocked as pure panic is already showing up on the bottom line, not just in press release language. Leiters basically summed up the whole philosophy in one line: strengthen profitability, cash flow, and resilience by refocusing on the core brand and the customers who actually keep it alive instead of chasing volume for its own sake. Stop trying to out-Tesla. Sell fewer cars, but sell the right mix across every kind of engine and protect the margin above everything else. It's close to the exact opposite of the all-in-electric bet that nearly sank the company 2 years ago. And it's paying off faster than almost anyone on Wall Street expected. It's worth being honest about one wrinkle in those numbers, though, because a good breakdown shouldn't just take the win at face value. A meaningful chunk of that profit jump wasn't organic growth. It was accounting. Porsche's one-time restructuring charges dropped from roughly 800 million euros in the first half of 2025 to about 100 million euros in the first half of 2026, a swing of around 700 million euros on its own. Strip that timing effect back out, and underlying operating profit actually fell by something closer to 20% year over year. The hedge strategy is real, and the shift toward higher-margin cars like the 911 is real, but part of this quarter's celebration is simply Porsche not repeating last year's one-off pain. That's a distinction worth keeping in mind before assuming the turnaround is fully locked in. Here's where this stops being purely a Porsche story and becomes a story about every car maker on Earth, including whatever's sitting in your own driveway right now. Porsche was, in a sense, the test case. If you wanted to design an experiment to find out whether a great legacy luxury brand could go all electric and actually win, you couldn't have picked a better candidate. Going in, it had more profit per car than almost any manufacturer alive, meaning real money to fund the transition. It had decades of some of the most respected engineering in the business. It had one of the strongest brand names on the planet and a genuine head start on electrification compared to most rivals, with the Taycan on sale since 2019. If any legacy automaker was built to make that leap and stick the landing, it was this one. It had every conceivable advantage, and it still got hit hard enough to wipe out 90% of its profit in a single year. That's the part that should be keeping executives up at night in Stuttgart, in Munich, and in Detroit. Because if Porsche, with everything going for it, couldn't force the electric future to arrive on its own schedule, every rival is now quietly asking the same uncomfortable question: what exactly makes us any different? And the lesson underneath that question is really the headline here. Porsche didn't get punished because electric was the wrong bet. Electric may still turn out to be the long-run future of the car. Porsche got punished because it staked the entire company's infrastructure on one aggressive, fixed timeline. When real-world demand showed up years later than projected, all that infrastructure turned into dead weight almost overnight. The bet itself wasn't necessarily wrong. Going all in with no fallback plan is what nearly broke the company. You can already see the rest of the industry making the same quiet turn. Mercedes, which once talked about going fully electric by the end of the decade, walked that timeline back and now plans to keep building combustion engines well into the 2030s. Audi scrapped its own hard deadline for ending new gas models. Volkswagen itself, the group that bet more aggressively on electrification than almost anyone, has extended the life of its gas and hybrid lineups even while pursuing a separate, sweeping restructuring of its own. Ford and General Motors have both slashed and delayed billions of dollars in EV spending after years of red ink from their electric divisions. One by one, the big players are quietly backing away from the aggressive all-electric deadlines they were proudly announcing just a few years ago. Porsche is simply the most dramatic version of that same retreat and by far the most upfront about the reasoning behind it. So, is Porsche actually out of the woods, or is this just a smarter way of managing a slow decline? Because the hedge is genuinely clever, but it doesn't solve everything on its own. Porsche is still caught in a real bind. On one side is the traditional buyer who wants the mechanical feel and analog soul the brand built its name on. On the other is the modern luxury buyer who expects Chinese-grade software and Tesla-grade charging built into every screen. Right now, Porsche is a bit too expensive and a bit too old school for that second group, and after years chasing the electric transition, arguably hasn't focused enough on the enthusiasts who kept the brand alive through the hard years. The hedge is Porsche's way of serving both sides without betting the entire company on either one again, and the early numbers suggest it's buying real time. But it's not, on its own, a cure. Porsche still has to claw back share in China. Where domestic brands have genuinely eaten its lunch, deliveries there fell another 32% in the first half of 2026, down to 14,501 units, and Leiters has said the company will plan its China business conservatively going forward rather than chase a recovery it can't guarantee. It still has to prove its electric models can compete with rivals who are now years ahead on software. And it has to do all of this while cutting deep into its own workforce, with reports of more than 10% of its roughly 40,000 employees being let go, on top of thousands of job cuts already announced, plus hundreds of millions more in restructuring costs still coming in the second half of this year. None of that is solved yet. The hedge simply means Porsche gets to fight those battles from a position of relative strength instead of outright collapse. And that's the real difference between the Porsche of a year ago and the Porsche of today. So what comes next, and why does any of this keep mattering? The full plan has a name, Strategy 2035, and Porsche is set to lay it out in detail at a Capital Markets Day on October 7th. That's the date the whole industry is circled, because it's where Porsche has to prove whether this hedge is a genuine long-term strategy or just a well-dressed retreat with a nicer name. Watch for how many electric models Porsche formally commits to and on what real timeline, whether it lays out an actual plan to win back China or quietly writes the market off, and whether that recovering margin holds up once the easy year-over-year comparisons disappear. Zoom out, though, because the bigger picture here reaches well past one German brand. Porsche just became the first major automaker to say out loud what a lot of executives have reportedly only been admitting in private over the past couple of years. Nobody actually knows what the future of the car looks like yet. Not gas, not full electric, not hybrid. Nobody knows for sure. For most of the last decade, admitting that publicly was treated as career suicide. You are supposed to project total, unwavering confidence in one electric future. Porsche just stood up, admitted the uncertainty out loud, turned that admission into an actual strategy, and got rewarded with a 34% jump in operating profit for doing it. That's the real statement underneath the headline. Not gasoline is back. Not electric is dead. The real statement is that certainty itself was the trap all along, and the smartest move a carmaker can make right now is to stop pretending it can see the future clearly and start building for more than one version of it at once. If you're new here, this is exactly the kind of story we love digging into. The business decisions and power moves happening behind the scenes that decide what eventually ends up in your driveway, long before you ever walk into a showroom. Subscribe if that's your kind of thing. See you in the next one.